Even a record first half $7 billion profit and a 35% increase in earnings was not enough to spare the giant miner Rio Tinto its share of the pain in the market rout, as fears grew that the commodity boom might come to a grinding halt. I spoke to Rio's chief, Tom Albanese, in London on Friday night before Wall Street opened and the news of the US downgrade had filtered out. Tom Albanese, have the events of this week on the markets changed your view of the economic outlook?
Well, we did again announce our results for the first half yesterday, and these were record results. We were very pleased with the numbers: $2 billion and more of cash flow per month. Our business in China continues to be strong. Our physical markets in Europe and the U.S. continue to be strong, but we do have to recognize that we are, to some extent, a lagging indicator rather than a leading indicator. So we're watching this with considerable interest ourselves. I think as I look into the second half of the year, I expect to see continued strength in the physical markets. We still would continue to believe that China will be growing this year at more than 9%, probably close to 9.5%, and that would leave global GDP growth in excess of 3 to 3.5%. We would be assuming the U.S. markets are really growing, but very, very slowly from a low base, and the same thing, even less so, from Europe. And if that's what we see for the second half, that's good for our businesses, but we do have to be watchful. We are in certainly volatile conditions.
What do you say to small investors now, in general, after this week's events? Hold your nerve or get out?
I think, again, watching the U.S. markets yesterday, there was not a lot of movement among retail shareholders, and there was not sort of a change in redemptions, et cetera, for mutual funds in the U.S. market. My sense is these are basically large institutional funds that are moving into more liquid situations. But so far, from everything I've seen in the meetings I've been having with banks over the course of today and discussions yesterday, not seeing a lot of retail movement. I think it's quite important not to be overreacting. I think we should be reflective of the fact that there are challenges in OECD markets. There's significant debt concerns in Europe and in the U.S. that do need to be managed. They're not going to fix overnight, and hopefully it's just going to take several years of progressive hard work and hopefully slow economic growth to get through this quite difficult stage that, again, the markets have been in for quite a while. But it's not necessarily an environment for overreaction, and certainly I would hope that people wouldn't be overreacting. You've
been spending a lot of time in China. What are you seeing there now?
Yeah, I've been to China several times so far this year, not just to the big cities in Shanghai, Beijing, but I've actually quite consciously been getting out into some of the interior provinces, Sichuan, et cetera. And I'd say that the growth continues. Certainly everything I've seen and all the discussions I've had would indicate to me that 9+% GDP growth should be expected this year, and that we'll moderate, but it'll still be well above 8% next year. The pace of building construction continues. It's shifting a bit from commercial and sort of the higher end residential to probably what would be more middle class residential, which we would see as a healthy sign. Probably real estate prices are still too high, and inflation's still a challenge to policymakers. But when I look at the people I talk with and what I see on the ground, that growth continues.
Well, obviously the world is full of things you can't control at the moment, but what about the things you can control, in particular costs? They seem to be rising lately.
We've had noticeable cost inflation, particularly in local hotspots, and Australia is very much a local hotspot. Of course, we had weather issues in the first half. Terrible impacts from the cyclonic activity, the flooding in Queensland, the heavy rains, and the weather conditions in West Australia. But we've also seen increased labor costs, increased input costs, particularly in mining hotspots. So Queensland, West Australia, parts of South America, parts of Africa are seeing higher than normal inflation. It has been offset to some extent by more normalized conditions in, say, the U.S., Canada, et cetera. But I think this is a challenge we're going to face not just this year, but in the coming years. It's going to be particularly important for us in Australia to do, if anything, do a better job of controlling our costs, because I think we're going to be suffering the dual effects of rising costs, rising labor rates, and a strong currency. And that's going to affect not only operations, but also the pace and the expense on capital projects. And again, it's very, very important to stay competitive in Australia.
How do you feel now about the Australian government's carbon tax proposal?
I've just mentioned to you some of the challenges we're facing on cost pressures in Australia. And the carbon tax as it's currently being envisioned will just add to those cost pressures and will create more competitive challenges. Here we applaud the courage of the Australian government to be seen to be ahead of the main actors, particularly the U.S., China, etc. Our position is that in terms of coming up with a price of carbon, our suggestion, our engagement would be that it should be gradual. It should be tested over time to make sure it's not having a negative effect. And certainly, this is not the time to be experimenting with the prosperity that we're seeing in the Australian economy. And if anything, some of the uncertainty in the financial markets that we've been seeing over the past 2 weeks only reinforce the point this is not the time to experiment with an economy.
Well, virtually all of your profit growth in the latest half year came from increased prices, and in particular of iron ore. How long can you keep increasing prices at this rate?
I'd say, again, we have to recognize that prices go in cycles, and that's why it's important to recognize that we can't allow our cost structure to get to a place where our businesses would not be sustainable in those normal low points of the cycle. Right now, our markets are actually quite strong, and again, these are driven by, again, the continued outperformance of the Chinese steel sector. It continues to consume more steel than people even would have predicted 12 months ago. Many producers around the world are struggling with their own supply and their own growth, and that's continuing to keep tight conditions and higher prices. Higher prices don't last forever, and again, I think it's really going to be driven by those supply-demand factors. I think our team on the ground, we work very closely with our Chinese customers and our Asian customers and all of our customers. They continue to want our product and will continue to deliver that product.
Your profit margin in iron ore is 70%. That's not sustainable, is it?
Again, I think it's about delivering the lowest cost production in a market which is quite strong, and again, expanding the business. So again, I consider our iron ore business to be the best iron ore business in the world. I think that the team in the Pilbara and our other iron ore operations around the world are positioned. They're at the right place at the right time. We have competitive ore bodies. We have a great set of capabilities. We've got, again, the rail and port infrastructure ready so that we can deliver to the market and we can expand for that market. So it's a good place.
Now, you've been giving a lot of money back to shareholders in dividends and share buybacks. But at what point will you go on the front foot and use that cash for acquisitions rather than giving it back to shareholders?
I want to say that we have a very strong set of organic growth opportunities. We've got great mines in Australia. We've got great development opportunities in Australia and around the world. And I'd say first and foremost, I want to look at bringing these new developments, these expansions into place as the market requires them. From time to time, we will look at the possibility of acquisitions. And again, first half, we were successful with Riversdale, and that's an Australian company in Mozambique. But again, this was something that frankly, most people didn't think we'd be able to successfully execute, and I was pleased to see that just this last Monday we reached the 100% compulsory acquisition point. So now Riversdale is 100% owned by Rio Tinto. We're integrating those Mozambique coking coal assets into the business, and again, it will be one more opportunity for future growth. We'll always keep our eyes on the commercial landscape. There's not too much out there right now, so again, when we have the best quality iron ore businesses, when we have a great copper opportunity in Mongolia, we have great now coking coal opportunities in Australia and in Mozambique, and a whole range of other things that we can do around the world. It's a strong position to work from.
Thanks very much for joining us, Tom Albanese.
Good to talk to you. Thank you.